Hi, everybody. Welcome to the Middle Class Investor. This is Seth Martin, your host. Thanks for joining me this weekend to discuss the markets. I've got a chart of the S&P 500, and as many of you know by now, we've got this rising wedge. We broke out of the rising wedge here back the first part of October, and made a pretty substantial decline, and now we've made a pretty substantial rally. So, a lot of the popular media is talking about, well, this is probably the pullback we've been waiting for, the correction we've been waiting for. That's kind of the way they like to everything. Every time the market sells off, it's a pullback, and most times it is actually. We've talked about kind of a technical analysis feature, which is when the market's in an uptrend and it pulls back, the probability is that the trend resumes. And so you can see that if you go all the way back, let's just put a 5-year chart up, you can see that every time the market's pulled back, it's pulled back to some level of support and then resume the uptrend. So it's kind of a 2 steps forward, 1 step back. Now this correction here was pretty substantial. They pulled all the way back to the other side of the channel, or the rising wedge, which at this point we didn't really know it was a rising wedge. But then the trend resumed, okay? So, that's a technical analysis feature that when you're in an uptrend, a pullback into some level of support is usually followed by a resumption of the uptrend. I think what makes this different, and what I want to clarify here, what I want to make sure everybody knows, is that this is my opinion. This is just based on my experience with technical analysis, is that what makes this different is this price consolidation in what I've been calling a rising wedge. And it's a pretty substantial pattern that happens in the market. Normally you don't see it happen over this length of time. You might see it happen over usually like a 3 or 4 month period of time, something like that. And this has been 5.5 years or something like that. So anyway, it's a pretty substantial pattern. I think I pointed out that once it breaks out of the pattern, which it did, it did here, and then it came back up, and then it broke out again. It actually broke out, looks like 3 times. 1, came back in, 2, came back in, and 3. Now, I suppose it could go in here again, but I don't think it'll close in here. We'll just have to see. But we're watching it close. I mean, this is a pretty substantial move. I think the market moved, 140 points in about 2 weeks, less than 2 weeks. So we had a pretty substantial run here, which is, is not uncommon when you have a big sell-off. A lot of times when you have a hard sell-off, you have a hard, bounce too. So we'll come back to this chart in a minute, but I want to go back to a weekly and look at the Dow Jones. There's another significant pattern on the Dow Jones. You can see it. I've got it marked here with these 2 blue lines. And this pattern also broke, and the beginning of this pattern is right here. And the way this pattern works is that if you get a break of this pattern, it usually goes back to the start of it, which is right here, 14,500 or so. So this is another one we're watching very closely. Now, it did go in here. It did close back inside the pattern. And then this red line, just to refamiliarize you guys with this red line here. This red line connects the 2000 and 2007 highs, and then all we did was extrapolate that into the future. So if I put like a 10-year chart on, well, actually I have to go back a little further than that. You can see here in 2000, you can see where I've drawn the line, and then again here in 2007, and then we just extended this line out into the future. So that's what that is, for those of you who don't know. Let's look at, while we're looking at weekly charts, let's look at the 10-year Treasury. And what you'll notice here on the 10-year Treasury, I had this this little dotted line drawn in here that I was thinking we'd probably hold and bounce from. Of course, we sliced through it in a big way. But then what's interesting here is what was formed is what's called a hammer. And hammers are usually very significant patterns in the market. It's just a candle pattern. So if you're interested, you can go to Google, look at candlestick patterns. You can look at a hammer. Now, for this hammer to be valid, actually, so technically right now it's not valid. For it to be valid, we need to get a close up above this body here, this black area. So it needs. You can see I've kind of drawn a line in here, this blue line. If we get a close at this blue line or above, then the hammer is confirmed, and this is usually followed by a pretty significant price move. That's what a hammer tells you. Normally on a daily chart, the hammer is very useful because if you have a day that looks like, well, in fact, this is also a hammer. So we could say that the hammer has confirmed. It's confirmed on a daily chart, but is not confirmed on a weekly chart. So, the market it opened up right here, it ran up, and then sold all the way off down here, and then pushed back up to this point. Next day, the bulls it gapped down, it ran all the way up, and closed about right there. The next day, it did close above the hammer. So on a daily chart, the hammer has been confirmed, but on a weekly, it has not. And but this is usually very useful on a daily chart because once you get a close above the hammer, that's a good place to enter a position for a longer term move upward. In this case, it can also work in the downward position. Now here, the neat thing, the unique thing about hammers, because you can see there's one right here that formed, but it kind of didn't really do anything. And the reason that is because the hammer has to form in a downtrend. Now, of course, you can let me do something here real quick. You can say that well, right here that was a downtrend, and here's my hammer. I don't know. Can you see that? Can you guys see that? This hammer right over here. Let me zoom in on that. So you can see here, this was a downtrend for sure, right? And then you have this hammer here, right here. Okay, and so, but you can see here in the first day or two, nothing actually confirmed above it. So this is kind of the nature of hammers. And then you can also see that not only did it not confirm, fairly immediately, but then also it came up and then you had another sell-off. So you have to be careful that, nothing is for sure, right? Just because you see a hammer on the chart doesn't mean the market has to go up. It's just, if you think about it in terms of what is happening, what's happening in the marketplace. Okay, so let's zoom in real quick and let's just talk about that, because it's a pretty important technical analysis phenomenon here, and I think it's probably worth talking about here for a few minutes. In this case right here, what happened is the market opened actually right here. Okay, it pushed up slightly and then sold off all the way down here. So the bears pushed it all the way down to this area. Okay, and then the bulls took control of the market and ran it all the way back up. So just without thinking about anything else, if you knew that sellers came in here, pushed the stock down, in this case bond prices up, okay, pushed it all the way down here, the bears did, and then the bulls came in and pushed it all the way back up, but then we closed a little lower. Would you say that's more would you say there's more bearish action there, or would you say there's more bullish? Anytime one side can take control from the other and completely reverse the price action, that's the direction That's the trend direction, okay? That's why the hammer is significant. I hope that makes sense to everybody. If not, if you want to look into it a little bit more, you can go to Google and type in candlestick patterns. You can type in hammer. You can type in haramis. There's all kinds of different candlestick patterns. Maybe sometime, we'll go over that here when the market's a little bit more quiet and lazy and there's nothing going on. Let's go back to the weekly charts and let's look at the euro. The euro, to me, looks like it's trying to bounce here. I'm not sure it's going to get a very good bounce before it resumes lower. And we talked about this before about potentially the euro coming into this support line here before we get, any kind of significant bounce. So we'll watch and see if that happens. Of course, if it breaks through here, it's likely to go to this zone. But in the intermediate term, this line should prove to provide some level of support before we get a bounce. Let's get volatility. As we talked about before, as the market goes down, volatility goes up. So, we had a really, if you kind of start right here, we had a pretty significant sell-off in the market. So volatility went up down to here, or up to here rather. And then since then, we've had a pretty significant sell-off, right? So volatility has rocketed down. It's actually broken through this blue trend line that I drew here. I suspect, though, that this trend line here, this green one, will probably hold. Volatility is a little bit, it doesn't work the same way as price action. So drawing trend lines and things like that doesn't work the same way with volatility. But it does give you an idea of kind of the general trend of volatility. And that's kind of what we're using it here for. Let's look at gold. Well, it's coming up here. Okay, there's gold. So let me zoom in a little bit. So gold, zoomed in a little too far. You can see back here in October of 2011, gold hit a high of $1,923.70. And it came down, it kind of came back up. And then it came down really hard, and it's been chopping back and forth inside this, what we've been calling a consolidation pattern. We talked about that if, right in this, I don't know, somewhere back in here, I drew this line, this red line right here. And I said, if it breaks this red line, it's probably going to break out of this triangle and go lower. So it looks like, it's going to retest the line here. It looks like it has retested the line. Let's zoom in a little bit. It looks like it's retested this line around 1231, and I would say that next week, if price action is lower in gold, then you'll finally see gold break out down here below 1200 to new lows, to new multi-year lows. That's what I'm looking for on gold. That is about it. Let me go back to the Dow and let's look at let's just look at a 9-month chart, and let's focus in on what's going on right here, because this is our pattern, this blue line here and this blue line here. Okay, can you see that? That blue line and this blue line marks our pattern. You can see here that on the October 9th we just broke out of it. Looks like on October 10th we tested it and then sold off, and we've come way down into this this area down here. I went a little too far. So what are we looking to happen here? What could potentially happen? Let's just talk a little bit about this, because we are at a place where literally anything could happen. I know that sounds crazy, but we're we're at some critical points, right? We've got this trend line here that marks the lower trend line of our pattern. We've got this line here, which is the 2007 to 2007 highs, okay? I don't know why that didn't snap to that. Yeah, for some reason it doesn't want to do that, but you can see the red line here. So, the question is, a new high is way up here. The question is this going to go up and make new highs? Now, it could pull back. It could pull back first like this and then go up and make new highs, okay? But let's talk a little bit about the odds of that happening, given that we're below our breakout for our pattern, okay? And we're below this decade and a half trend line for the highs, which I think is significant. We've shown that in the past. So I think the odds are, I think you still have to say the odds are that the trend is probably up. But what you need to be, this is kind of a yellow light situation. What you really need to be looking for is for the market to begin getting tired here. You get, I don't know, you get, something like this, maybe something like this, and then you get something like this, and something like this, okay? I don't know. I'm guessing really right now, okay? But you could get a tail that kind of takes it up above this line and then immediate sell-off, or you could get a tail, you could get something like that here where we pull back a little bit, where this box comes down a little lower, but the tail extends up and then begins to sell off. So there's a number of different possibilities here. Nobody knows what the future is, and we can't possibly know. It's unknowable, okay? And this is the difficulty. This is why you can't just go out and get rich trading the markets. There's potential losses everywhere, right? So you can't just be 100% all in on something. So that's why the whole 401k IRA thing makes me crazy. It's because literally most people are just all in, and for me that doesn't make a lot of sense. What makes sense to me is you have some sort of risk control. There's some level of risk you're willing to take, and when you get to that point, then you take money off the table, or you change your positions or something like that. But so we're talking about this chart, but I want to throw in something here. So let me zoom out, and I want to just go over here and throw in the volume on the Dow. So bear with me just a second. I'm going to put the volume in, and you can see I've already got something drawn on here. I'm going to zoom in a little bit. But I want you to notice, if you would, I can get that to stop moving around. Okay, notice here that in this downtrend, so this was pretty substantial. I mean, I don't know if you remember, but I was listening to CNBC, and Jim Cramer was talking about, well, we underestimated Ebola, we underestimated ISIS, we underestimate. He was coming up with all kinds of crazy reasons why the market was selling off. Okay, and so anytime I hear any kind of craziness like that, that's emblematic of fear. Okay, look what was happening. Volume was increasing. So the more downside there was, the more people came in and sold. Okay, now look at what was happening here. No doubt that we had a really strong rally. Okay, very strong. Okay, 140 points in 1, 2, 3, 4, 5, 6, 7 trading days. So not even a week and a half. But look at the volume. Look at this right here. Now this you have to figure into your odds. Well, that didn't snap to that, but anyway, I've got it drawn on there. You can see the the dashed line, how the volume is dropping off. So what do we have? We have selling under increasing volume, and we have buying under declining volume. Well, why does this happen? Well, because people with big money can't just throw all their money in the market and then throw all their money out of the market. They have to creep in. So what was happening is they're creeping out here, right? And then they're coming back in, but they're coming back in with less. Okay? And that way, next time they come out, they can take a little more out. So they don't just move all their money in and move all their money out because they have trillions of dollars in the marketplace, and it would just crash the market. So they're just moving incremental amounts of money in and out of the market, and that's what causes this volume to, either diverge or converge with the direction of the trend. So, having said that, let's go back and let's talk about. So let's factor that into the probability, and let's talk about what we might see here. So here's our old high over here, okay? I don't know, is that on the screen? I'm not even sure. Our old high is back here, okay? And then we've got a low here. So right now, in this low right here is lower than the previous low, okay? Let's show that. I'm just going to go to a regular screen here. And let me zoom out a little bit. Let's zoom into right here, okay? So this low, this most recent low, let me take the volume off. This most recent low right here is higher than this low. So this is a lower low, okay? And this high is lower than this high. So this is a higher high. So we have a higher high, but now we have a lower low. And then we have something right in the middle. So potentially this is a trend change, right? Because if this comes up and then turns and goes lower below this low, 15.8 or whatever, now we've got a trend change, right? So that's what we have to be on guard for. That's what we have to be on the lookout for. And just like I've been talking about in the bond market, if this is an important high, which it is, it's an all-time high, and this was a significant move downward, which we just showed with the increase in volume, and this is the first correction off the first move down, then that means this next move down is going to be very significant. And if we go back and look at our rising wedge, we've been talking about numbers in the mid to lower 1700s on the S&P, and we've been looking at numbers like 14,500, 14,250 on the Dow Jones Industrial Average. So my guess is, you probably don't want to experience 2,000 point loss in the Dow or a 200 or 300 point loss in the S&P. So what we want to do is we want to be able to make a decision if that's what you choose to do. Okay? And the way we do that is we say, okay, well here's an important high and here's a low. Now here's a lower low. If this right here turns and starts going this way and takes out this low down here, then now we have a trend change. And that trend change could be pretty significant. In May, you may want to take a little money off the table. Some of you may not. Some of you are diversified and you like being diversified and all that kind of stuff. But really what I'm after here is I'm after what's your quality of life? Are you sleeping at night? I mean, if you can stay diversified and take a 3, 4, 5,000 point loss in the Dow and it doesn't bother you, then that's fine. Be diversified and be in for the long haul and all that kind of stuff. But if you're 70 years old or 60 years old, that may not be the best strategy for you. Making that money back, the number of years you have to do that can become problematic if you're later in life. So I'm just trying to give you a strategy for making a decision. That's really what we're trying to do here. If you choose to make a decision, a good logical place to make a decision, given that we've shown that we have these important patterns, given that we've shown that we had increasing volume on the way down and we had decreasing volume on the way up, you might look for, and given that this is a 14-year trend line, you might look to take some money off the table, or put some money in cash, raise cash. Because here's the thing, I've had people tell me this before too. Seth, I just always buy. I'm just always a buyer in the market. Okay, well that's fine, but if the market sells off 40% and you're all in, diversified or not, you're all in, okay? What money are you going to use to buy when the market's done going down 40%? Everything in your account has gone down 40%. Now you could go to your bank, I guess, and get some more money and put it in, but my point is you have no money, you have no investable money in your 401k or IRA to be a buyer. So the prudent thing to do is listen to what the market is telling you, look for this potential trend change, i.e. I've got a high over here, I've got a lower low, I potentially have a lower high, okay? And if the market starts to go like this, then maybe somewhere in here I could make a decision, okay? So that's really all we're saying here. And the reason I'm talking to you on YouTube about this is so that you can mentally start preparing yourself, because if all of a sudden stuff starts to happen in the market and you're mentally not prepared to make a decision at some point, then you're gonna question your thought process. You're gonna say, well, I don't know, I'll just wait for it to come back, and well, I don't know, maybe it'll come back. Kramer says it's going to come back. Ben Bernanke's going to print more money and turn on the QE spigot again, and so on and so forth. The problem with this whole QE thing is the longer you do it, the less effective it is, because people start to realize that it's just not working. And I could show you some charts where they've started QE and finished it, and the market trades, almost opposite to it. So who knows if it's even working? I think it works to get a big rally, but then that big rally may fade and turn the other way. So I don't know that you can, whether QE works or not. What you have to do is you have to look at the way you make money in the market is by getting in front of the big money. Okay, where is the big money going? And you get in front of that and you ride it like a wave to the shoreline. So it really does no good for you to say, I think QE will work, or I don't think QE will work. It really doesn't matter what you think. All that matters is, what does the big money think? Okay, and how do I get in front of it? Because if the big money wants to take the market down 70 or 80%, and you're in the market, you're going down 70 or 80%. That's just the way it is. That's the way it happened in 2008, and that's the way it'll happen every time the market wants to go down that much. And if you're in the camp that says, I don't believe that could happen again, you really need to get over that too. You need to kind of have the idea that the market can do anything. I've shown in this room before, or in this YouTube channel, that let's look. I'm going to look at the S&P 500 real quick. Well, let's just look at the Dow. This was 1929, the 1929 crash. The market went down 90%. Let me zoom in on that for you. Hold on a second. That's not what I wanted to do. Let me zoom in right here and show you this. Well, that zooms in too much. I'm going to measure from here down to here. Okay, so the market high in 1929 was 386.10, and the market low in 1932, July 1932, was 40.60. Let's measure that. That is 89.48%. Okay? If you're all in, diversified or not, your portfolio is going to go down 90% if you're in the market in 1929. Now, that is crazy, right? I mean, who would have thought right here, okay? You're right here. Oh, there's somebody out there talking, man, the market could go down 50% from here. Well, 50% from here is only 150. Let's see how long it took to go to 150. April 1931. So it took not long at all. Let's see how long that took. It took 454 days, so a year and a half, to go down to get cut in half. Well, surely that's a good place to get in, right? And you scroll forward, and there's just even more selling. So you just have to. You have to first come from a place that says the market can do anything. Just because the people on TV say, "Oh, that's a 1 in a 100-year event," that doesn't mean anything. It doesn't matter what they say. All that matters is what are the participants that are trading these stocks. What are they doing? That's all that really matters. And one of the reasons I showed you, the massive amount of debt that the banks have, and the leverage, and the derivatives, and all that stuff. I showed that a few webinars back or whatever. The reason I showed you all that is because that's what drives this. That's what drives these massive sell-offs. And the market, the economy expands based on the amount of credit expansion that takes place. And then when there's a wave of defaults and that credit goes away, the market contracts, and it causes stocks and stuff to go down. So this is really unlike any time that any of you that are listening to this now have experienced in the market. You really have to go back to the 1920s, the 1930s, to find another time that's like the time we have right now. So, and really, right now what we have is unlike any other time in history that we've had as a country. So there are some significant, and I know interest rates are low, and I know, there's all kinds of reasons out there. Well, interest rates are low, and valuations are low, and all this kind of stuff. But none of that really matters. All that really matters is there too much credit, and is there going to be a wave of defaults? That's really all that matters, and it's going to drive these valuations. It drives everything. It drives how many people get employed. It drives how much money people spend. It certainly drives how much more money they're willing to borrow. Right? If you just defaulted on all the stuff that you had, how likely are you going to go out and go buy a bunch more stuff? Not very likely. So it has a huge impact on the economy. Just try to get your head around the fact that the market can do anything, and it doesn't do you any good to argue with the market. All you can really do is try to make some sense of the price action, and then try to pick a place where you can make a decision that's logical and rational. Okay, and that's what we're trying to do here. So that's it for this week. I kind of got on a soapbox there and preached a little bit. But I think those are very important concepts, and maybe we can go back to technical analysis sometime and discuss that. But I think we're at a very critical juncture in the market, and I want to make sure everybody is mentally where they need to be to deal with the next phase that's coming. Okay? All right, everybody. Well, thanks for coming in this week. This has been the Middle Class Investor. Share the YouTube with your family and friends. You can follow me on Twitter. Usually after this video, I'll share it on Twitter and maybe retweet it a couple times, see if I can snag people that way. But the best way to get people is just, you guys tell them, hey, I think you should watch this. This will help you understand what's going on in the market, that kind of thing. All right? Well, until next week, everybody, thanks a lot for coming in. We'll see you. Bye-bye.